I want to shift over, though, to the rest of what we're seeing play out as we do have a recovery underway here after yesterday's intense sell-off. Of course, coming off the largest monthly jump in consumer price inflation we saw since 2009. A lot of jitters still swirling about just how quickly the Fed might have to change their tune with investors. We, of course, heard Jay Powell talk about froth in a response to our own Brian Chung's question there at the last Fed meeting. We also heard Janet Yellen talk about interest rates maybe needing to rise somewhat to make sure the economy doesn't overheat before she walked that statement back. But our next guest has been talking about the Fed shifting policy quicker than people might be expecting and warns that when the Fed does indeed make that official, it could trigger another 10 to 20% correction. And for more on that, happy to welcome back into the show Satori Fund founder and portfolio manager Dan Niles. And Dan, we've been forecasting, or we've been talking about forecasts on Wall Street moving up the expectations that the Fed is going to have to move away from its fully accommodative stance sooner. But how wide still, I guess, is the gap between what the Fed is saying and where the market is right now?
I mean, the gap is still pretty wide because, the Fed still sticks to the fact that they're not going to raise rates through 2023. And, that sounds great, but inflation, if you've got food prices, energy prices, shelter prices moving up as rapidly as they are, the Fed's not going to have any choice. They can say what they want. This reminds me to some degree of them saying, back in 2007 that the subprime crisis was well contained. Obviously it wasn't. And I think it's the same issue with inflation because some of the things that are causing inflation, which they think is going to be temporary, I think is going to be persistent in the sense that, companies haven't invested a lot over the last year because they've just been trying to stay in business. So there's not a lot of excess capacity in that regard. And really over the last decade, GDP's only grown 2.3%. So, that growth is the slowest recovery from a recession in history. And so companies just haven't invested a lot on the capacity side. The same token, you're going to get the fastest GDP growth we've ever seen in decades for both the globe and the United States. So you combine those two things, and I think you're going to have very strong inflation that's going to last a lot longer than the Fed thinks, which will force their hand into moving a lot quicker. And the first thing, obviously, being tapering, just cutting that 120 billion in bond purchases a month. And that's what I think will trigger a 10 to 20% drop in the markets.
And for timing on that, I mean, you project that might happen, that tapering might happen later in the summer, correct? I mean, we look around the globe even just at kind of the pressure pointing out, you've talked about the Bank of Canada starting to taper. You've talked about pressure elsewhere in the globe here to kind of shift off their accommodative stance. But I mean, when you think about that 10 to 20% correction, I suppose it kind of always comes back to the idea of the Fed trying to signal this stuff, but for so long it's been all about being accommodative until this recovery happens. So I mean, how do you see that playing out if they are to shift in tapering this summer? How they maybe frame that without things going to the extreme of everyone saying, look, this is going to be a light switch kind of turnaround?
Yeah, I mean, I think there's two things. They're going to have to signal it first, and then they're going to have to do it. And so I think what you'll see is them starting to signal that they're going to taper sometime during the summer, I think at least by Jackson Hole, which is in August. It may happen sooner than that, given the inflation figures that are coming out. And then I think they'll start tapering before year end. If you look at central banks around the globe, and you brought this up, we put this out under a tweet under @DanielT_Niles, and we've got some charts around inflation on danniles.com that we put out. The Bank of Canada has already started to taper. That's the first G7 bank. And then the Bank of England, just this last week, also said they're going to start to taper. But if you look at emerging markets, Brazil's already, their central bank has already raised rates twice. Russia's already raised rates twice. You have over 10 central banks that have already raised rates, never mind tapering. And so, this process has already started in other countries around the globe. And I think the U.S. is just going to be, lagging that and playing catch up, which is why it's so disruptive. None of this would honestly matter if valuations were low, but they're not. They're at record highs. So if you look at market cap divided by GDP of the entire United States stock market, that's sitting at 1.8 times. The average over the last 50 years is 0.8. And the peak during the tech bubble for that metric was 1.4. So, if we were at average valuation levels, it wouldn't be such a big deal. But when prices of everything, including Bitcoin, which you talked about in your earlier segment, or non-fungible tokens, or you pick your favorite asset class, stocks, tech stocks in particular, with no profits. Those have run up a lot, and those are the things more at risk when rates go up.
Yeah, so I mean, when you break down that risk reward to come back to how people should be kind of framing their portfolios around this, obviously it doesn't seem like it would bode well for leaning into growth names right now. And if that's a 10 to 20% market correction, I mean, obviously you would expect it to be much worse based on the way that 2021's gone so far for those tech names. So how should investors be defensively positioned? And what are those names that you're looking at to maybe play that the best way possible?
Yeah, so for us, we always have a mix. We're a hedge fund, so we have longs and shorts. And, in terms of names that we like, that we think will outperform, which means go down less in a 10 to 20% correction, names like Google or Facebook, they're great names in the sense that they're growing the top line by 30%. They're trading at a market multiple, which is amazingly good in terms of valuation for that growth. And so we like them. They also benefit from reopening in the sense that if GDP picks up, advertising picks up from, airlines and hotels and vacation spots. And that really helps, especially Google, which has about 10 to 15% of their revenues coming from that vertical, but also Facebook. So we like them a lot. We're looking at names in the Chinese ADRs that have gotten absolutely killed ever since, China blocked the Ant Financial IPO back late last year. A lot of those names are down over 30% from their 52-week highs. And you've got valuations that are, becoming more interesting as expectations get reset for those. But, we have a lot of shorts on. I mean, that's why we've done really well. I mean, the market had its biggest 3-day drop for the S&P since late October. We actually made money over the last 3 days. That's not because our longs did well. Our longs got hit, but our shorts got hit a lot harder. And, we have a lot of names that are exposed to, more unprofitable areas of tech, a basket of those. And those have done very, very well. So I think investors need to have a balance between the things they like and the things that they think are going to get hit hard. And that's the way to sort of survive even and make money, hopefully, during a 10 to 20% correction if that occurs.
Yeah, those hedges and diversification important if we are to see kind of a bout of volatility return, or just what we've seen over the last couple of days continue here. But you did mention the ADRs. I wanted to kind of wrap up on that because we did see Alibaba shares under pressure today. Reported their latest quarter sales topping expectations, about $28.6 billion there, but it swung to a net loss after facing a fine from the Chinese government. So curious to see how maybe, if you're talking Google and Facebook there, how these ADRs maybe fit into tech plays given the pressure that's come onto them from the Chinese government there.
Yeah, so if you look at Alibaba, it's a great point you bring up, Zach, because they beat revenues by about 4%, but they missed their profit targets by about 20%, excluding the fine, which is the way I think you need to look at it. And the biggest thing was they said on the call that they'd be reinvesting all their profits in the future. So you're going to see estimates come down after this print, probably by around 10 to 15%. But don't forget, the stock's down about 34%, I think, from its 52-week high. The other issue with the quarter was their cloud business went from growing 50% in the December quarter year over year to 37% in the March quarter. So that decelerated quite a bit. Obviously, 37% is still amazingly strong growth for a company of this size. But I think the ADRs are actually getting pretty interesting. We're actually starting to build a small position in it today. If you can get 30% top line growth, which is what they guided to at a 20 PE, that's pretty compelling. And that puts it sort of in the same category as Google and Facebook. Obviously, a lot more regulatory related issues with the Chinese government with Alibaba, but that's been going on for a while. And so sentiment's gotten pretty depressed on a lot of Chinese ADRs. We're looking at some other names actually in that space as well, because this is all really comes down to risk versus reward. You're seeing that with Bitcoin today. When things have run up so much because of easy money, if after 13 years of Fed giving you easy money, they now all of a sudden start to pull that back, you're going to have to rethink where you're invested to get a better risk versus reward trade. And lower valuation names that make lots of money, that's kind of where you want to be.
Well, at the very least, investors watching this show can't say they haven't been warned of that potential correction here. But Dan Niles, Satori Fund founder and portfolio manager, love having you on, man. Got to have you back soon.